The aim of this presentation is to analyse various economic variables that have the potential to impact the value of a nation's currency, specifically the Australian dollar, the Great British Pound, and the Japanese yen. Following this analysis, we will compare and contrast the most influential factors in order to gain some insight as to what future trends in the currencies will be. Through analysing various economic factors, as detailed above, we have chosen 3 significant variables that will have an impact on the value of the yen and the pound when being exchanged with the Australian dollar. As for the yen, political stability is one factor that will occur. Political stability measures the perceptions of the likelihood that the government will be destabilised by unconstitutional means. While this is unlikely in a first world country, we can still assess the effects that politics has on the economy. Japan's government is relatively stable, being ruled by only 2 groups since the Second World War. The World Bank rates Japan's political stability as very stable. Daily effects has observed that the Japanese yen is currently weakening due to reports that the Prime Minister is considering an early election. As for Japan's private debt, it's among the world's highest, last reported at over 230% of their gross GDP. This level is unsustainable and a prime factor in discouraging investment into the country. As for Japan's government debt, they clearly have the world's highest level, once again over 230% of their GDP. This is incredibly unsustainable and is linked to poor credit ratings that will be discussed further into the presentation. High levels of any debt discourage foreign investment, and these figures have been sourced from trading economics. Interest rates in Japan have been stable for years. In 2016, they fell from 0% to negative 0.1%, making it an undesirable destination for foreign investment into the money market. This has weakened the value of the Japanese yen. Over the past 9 quarters, inflation rates in Japan have been stable and at a desirable level. These are currently at 1.6% per annum, as posted by Trading Economics. Trading Economics has Japan's commodity prices as stable over the past 9 months, and there is no evidence to suggest that they will be destabilised. Japan's economic growth rate has been rising at a sustainable level since the beginning of the 2016 year. Credit rating is used by wealth funds, pension funds, and other investors to gauge the creditworthiness of countries and therefore can have a very large impact on the borrowing costs. All of the major credit rating agencies have predicted Japan's rating to be stable, with common ratings of A+, A1, and A.
As stated by the Australian Business Council, Australia is considered to have a high level of political stability. This is further backed up by the fact that the government has only been run by 2 parties since the 1930s. The private debt in Australia has been quite stable in the past 3 quarters, sitting at 123.1% of the GDP. Whereas the government debt within Australia is currently sitting at 41.1% and has been rising exponentially over the last decade. This is due to the government running consecutive budget deficits over the past years, which will likely weaken the dollar in the future. However, the net debt, which accounts for the total assets of the government holds, only sits at 20% of the GDP, as seen in the 2016 to 2017 budget report. The inflation target as set by the Reserve Bank of Australia is 2 to 3%. However, the current level is sitting at 1.9%, which is just below target. This is not an uncommon occurrence, as depicted in the graph by Trading Economics. However, the rate appears to be falling again, although lower inflation rates tend to have a less effect on the Australian dollar than higher inflation rates. Commodity prices in Australia have increased by 1% in August and 20.1% over the past year. This is mainly due to higher coal and iron ore prices. This is further backed up by a NAB study, which has found that prices will likely continue to rise in the near future. Overall, the Australian economy has grown by 0.8% in the last quarter, as quoted by the Australian Bureau of Statistics. The overall exports of the economy rose by 2.7% and the terms of trade fell by 6%. The RBA board have voted to leave the cash rate unchanged at 1.5%, which has been the case since the mid-2016s. The decision is believed to allow the Australian economy to prosper, but is unlikely to attract new and foreign investment. Currently, Australia's credit rating is sitting at a AAA credit rating, but is in fact one in 3 risk of falling down a level within the next 2 years. This is due to Standard & Poor's casting doubts that the economy will reach a budget surplus by 2021. A fall in Australia's credit rating will considerably reduce the amount of foreign investment in the country, potentially weakening the value of the Australian dollar.
Political stability in UK has created uncertainty, from the vote of the referendum to leave the European Union. This shockwave sent uncertainty into the UK as former PM John resigned and Theresa May stepped in. After leaving the EU, this has created an opportunity and problem for the UK, as the free trade agreement between the Euro countries has now changed. With an early election set up and coming up soon, it has created more uncertainty in UK and has made market expectations become more unpredictable. This causes a depreciation in the UK as the uncertainty leaves consumers unwilling to spend or invest in the GBP. UK's government debt stands at 110% of GDP, which largely decreased from last year from the World Bank as shown. A high government debt is likely to decrease the value of the Great British Pound, as the country are unable to pay its debts. UK's private debt is currently stands at 230% of GDP, and it has increased from the last year, as figures show from Trading Economics. UK's growth has slightly increased from previous years. The current interest rate for UK is 0.5%. This would discourage foreign investment as it is lower than other countries. Inflation rates are beyond the government's and Banks of England's desired goal of 2%. Inflation currently sits at 2.9% as depicted in the Trading Economics graph, and is expected to increase to around 3% figure from Trading Economics.
Commodity prices. The Japanese export prices are falling, whilst Australia's commodity prices have risen by 20% over the past year, with this trend predicted to continue into the foreseeable future. This should be a concern for Japan, as they rely on Australia for over 16% of their imports, with few substitutes available. As a result of this increase in commodity prices, an increased demand for the Australian dollar will occur. This will result in the yen depreciating against the Australian dollar. Another point is credit rating. Due to Australia's consistent budget deficits in the recent years and an increasing foreign debt, Standard & Poor's has predicted a 1 in 3 chance of a downgrade from a AAA credit rating. In contrast, while Japan's credit rating is already poor, it is expected by all major credit ratings agencies to remain stable. The negative effects of Japan's poor credit rating has already affected the value of the currency. If Australia's rating is to fall, then foreign Japanese investment is likely to shift from Australia to countries that pose less risk. This will result in a decrease in the strength of the AUD against the Japanese yen. Now into debt. When comparing the various levels of debt across Australia and Japan, it can be seen that the debt in Japan is significantly larger. Currently, Japan's private debt is at 231% of its total GDP, compared to Australia's private debt, which is only at 123.1% of its GDP. In terms of government debt, Japan's is one of the largest in the world, totaling at 230% of its GDP, with Australia's only just breaking 40%. The debt level in Australia is considered to be quite stable, whereas in Japan it is so high that foreign investors might be deterred, and this will result in a depreciating in the exchange rate of the Japanese yen. Through analysing the commodity prices, credit rating and debts of both Australia and Japan, we can predict that the Japanese yen will depreciate against the Australian dollar in the coming months.
Political stability. With the United Kingdom set to carry out a premature election, the perceptions of the political stability has created uncertainty within the foreign investors, including Australia. This is due to the market expectations depreciating the value of the GB, considering that Australia is considered to have a strong level of political stability. Australia's market expectations won't be as uncertain as the UK's. This means that foreign investment in the United Kingdom could potentially be discouraged, causing a depreciation of the GBP, as the demand for the currency will drop, causing an appreciation of the value of the AUD against the GBP. Inflation rates. The inflation rates within the United Kingdom are rising, currently sitting on 2.9% as shown in Trading Economics graph. which is currently above the target range of 2%, whilst Australia's inflation rate is currently falling and is below the target at 1.9% from the RBA. Due to both countries exhibiting unchanged interest rates, there is no reason to believe that these trends will not continue in the current directions. This will mean that inflation rates in Australia will continue to fall, whilst inflation levels in the UK will continue to rise. As a general rule, countries with a lower inflation experience a rise in currency value as purchasing power increases relative to other countries. Based on these trends, it can be seen that the AUD is likely to appreciate against the Great British Pound. Through analysing both inflation rates and the political stability of Australia and the United Kingdom, it can be seen that the AUD is likely to appreciate in the coming months.